Well, I personally think the Fed should drop rates. I think they really slowed us down. There's no inflation. I would say in terms of quantitative tightening, it should actually now be quantitative easing.
All right, you heard it. The president wants rate cuts. This man is Ryan Payne, president of Payne Capital Management. Would you want rate cuts now?
No, I think the economy is growing modestly, so you have to keep that in lockstep. There's no reason to go overboard with the rate cuts at this point. You need some ammunition later when the economy does heat up to actually cut. So right now you got slow and steady, so I think the Fed's smart to hold.
So what you mean, no, wait, you got that the wrong way around.
Yeah.
If the economy starts to slow down in the future, you want to be able to cut rates.
That's exactly right.
Cut them now, you don't have much ammunition left. That's what you're saying.
Bingo.
Okay. Now, a lot of people, especially of my age,
yes,
are getting out of stocks and into bonds.
Yes.
Now, should I follow that herd mentality, go with the herd and get into bonds?
Okay, so here's the problem right now. You have what I call a bear market bond trap. So,
well, you better explain that one. You really should.
So you have to look at what investors have been doing this year. So first off, the market's up almost 14, 15%.
Yep.
Great year for
That's
stocks.
Yeah.
That's stocks. And investors have been pulling money out of the stock market in droves. You literally have had $80 billion come out of the stock market this year as the market's going up.
$80 billion out of the U.S. stock market? Or is
internationally.
That internationally?
Globally. The entire market as a whole.
Well,
okay.
So what?
So market's going up and you're selling, which seems counterintuitive to start.
But you don't know that it's Americans who are selling. I mean, it's the American market, stock market that's gone up. But you don't know that it's American investors who are selling stocks as it goes up. It's probably international people, isn't it? It's
both across the board. And remember, the foreign markets are going up this year, too. So you're selling out of the foreign markets going up over close to 13, 14% as well. Emerging markets are actually leading right now. So you have money globally coming out of the markets. Furthermore, now you have interest rates going down and bond prices going up. It's like a seesaw. When interest rates go down, bond prices go up, and vice versa. When interest rates go up, bond prices go down. So right now, with interest rates going down, you have $70 billion, going to bond funds. So that means when prices are higher and yields are lower. So if you're locking into long-term yields right now, it's going to take you like 30 years to double your money. So not a great deal where I come from.
So, okay, are you telling your people, you're a wealth management kind of guy, you say stay in stocks?
What I'm saying is, if you're going to own bonds, own that right. Don't own bond funds, because here's what's going to happen, Stuart. Okay.
Wait a second. Someone of my age doesn't want much risk. There is risk in stocks. There's not that much risk in bonds. I know pretty much what I'm going to get, don't I?
Depending on how you own them, right? If you own your bonds outright, they're going to come due in the future. If you're in a bond fund, here's what's going to happen. If the global economy picks up later this year, which I think it will, especially if we get a deal with China, interest rates will probably start to go up globally, which means U.S. rates will start to go up. When that happens, bond prices start to depreciate. And if you're in a mutual bond fund with other investors, they're going to say, well, I'm losing money in this, and they start selling. Everyone starts to sell at the same time. So it's like you're going down an elevator with people you don't like.
Yes. That's a good point, actually. Yeah. Should I sell my Microsoft?
So you love Microsoft?
Well, I own it. Not the whole company, I might add, but a little tiny sliver. Should I sell it?
I wouldn't sell it here because, again, when you talk about dividends and you talk about being in equities long-term right now, cash flow is very good on Microsoft.
What's the long-term for a guy who's 70 years old? Come on, what's the long-term?
What's the long-term? Well, a young, healthy guy like you, I give you at least another 20 years.
Next Thursday. Just kidding.
Tell me an absolutely risk-free, very low-risk investment for someone in my position at my age.
Okay, your age, you want to generate cash flow, right? So that's number one. So I think you want to own a bond portfolio that comes due. That's critical. Permanence and definition is what we call it. I know the interest rate I'm getting. I know the money's coming due. A bond fund does not provide that. On the equity side, you want to have some equity exposure because of the dividends. It's about cash flow, and that increases over time, which keeps up with inflation, because cost of living is going to go up for you, my friend.
My friend. Cost of living is going up. All right. Ryan, thank you very much, sir.
Thank you.
Good stuff.